Okay, folks, welcome to a swing trader review of our trade of Carbonite. So before we go into the recap of the trade of Carbonite, what we're going to do is we're going to first talk about our strategy as a whole. Our strategy at the Contrarian Trader is to maintain concentrated core positions, meaning we look for opportunities with stocks, commodities, whatever, that are breaking out of long-term basis. Case in point, gold has broken out of a long-term base. We have been long of the gold miners using the NUGT for quite some time now. We are up on this trade roughly 80%. We were up as high as 130% last week at the highs of the week for NUGT, but we backed off the highs of the week given this bearish reversal bar. So we understand that when we're concentrated in a position and we get pullbacks, we want something else to help compensate for the risk-on environment for stocks. And when you're in a risk-on environment for stocks, that means that commodities, I have my charts over here on the other monitor, commodities such as gold, silver, the miners will probably pull back, and that's exactly what you saw last week. So yeah, we had a pullback on our NUGT position of about 14.3%, and in all probability, we're going to get another weekly low coming soon. I don't view it as an end of a bull run here. I view it as an opportunity to begin adding more to the position. So while we like to maintain core concentrated positions that are in a long-term uptrend, I also like to swing trade around those positions. Now, how we decide what kind of trades we want to put on, meaning swing trades to trade around our core positions, really depends upon the health of the overall market. So, case in point for Carbonite, it's a micro-cap stock, right? So we see that the IWC, which is the micro-cap index, was in a downtrend and remains in a downtrend. Taking a look at a weekly chart to get that higher level view, you could see lower highs, lower lows, not much going on here. So do I want to look for swing trades that are momentum trades? No, because the sector is in a downtrend. What I want to do is I want to default back to our contrarian trading style, meaning I want to look for stocks that are at distressed, extreme, unsustainable, oversold levels. Case in point, Carbonite. Now, Carbonite, when it hit our screen, we began talking about it back around here, early August, when we had RSI at around 15. And I mentioned back then, listen, the markets are weak, and these micro-cap stocks can have RSIs below 10. So let's be really careful here as we build a position in Carbonite. And case in point, when you take a look at not just the IWC, the micro-cap index, when you take a look at the Russell 2000, it too has been lethargic at best, weak at worst, right? It hasn't been doing anything for about a year and a half now. So again, we want to focus on our risk. What trade best suits a market environment that we see ourselves in right here, right now, and is best suited for our risk tolerances, and that is extreme oversold stocks. So let's talk about our strategy for opening up a position on Carbonite. So we'll begin with the daily chart. Carbonite had RSI at the lows at around 8, 9, so below 10, okay? Unsustainable. So on the 20th of August, we knew that we were at historical support levels. How do we know that? We did our homework. Here's a weekly chart. We knew that we had historical support at this level going back to September of 2016. So we had RSI in our favor. We had historical support in our favor, but we can't be guaranteed that that support level is going to hold, especially in a market environment where volatility was rising. So we had to build a position in increments, and we had to hope that that support level would hold. If after a few days, this support level would have held, well, then we could have added more at that support level because confidence is building. However, it didn't hold. So let's take a walk through what we did next. So on August the 20th, the shares were down on the day, and I said, you know what? I know we have support at around the 1385 level, so I priced out the puts. So I sold to open. Now, when people hear puts, they think, oh, he's bearish. He's looking to take advantage of the shares pulling back and to profit off of the options. No, that's when you buy an option. In this case here, what we did is we sold to open a put contract, the 15 strike price expiring in September. We brought in a premium of $1.15. What did that do? If the shares were put to us when the options expired in late September, our basis cost wouldn't be $15 per share. Remember, we were paid a premium of $1.15. So our true basis cost is at $13.85. So that put us right at where we wanted to be, right at historical support. So, okay, so we used the options to open up a position. And then as we began to pull back even lower, and now we're probing our historical support levels, we added more at $13.84. But now that we were at historical support, I wanted to begin buying the shares at historical support. Were we overly aggressive? No, we were respecting the health of the overall market. The health of the overall market was a bit weak, but we still had RSI, which was at unsustainable levels. We knew there was going to be a rally, and we had a catalyst. What was that catalyst? We knew that there were a bunch of shorts in Carbonite, and what they were doing is they were falling asleep at the switch. I mean, this was unsustainable, yet they still wouldn't cover their positions. But I knew that they were going to have to fairly soon. So we stopped adding to our position on the 21st. Why? Back to the weekly chart. So what we did is, this is the week of the 19th. So we had those two trades. We sold the put options, 15 strike, averaging our cost down to $13.85. Then we bought common stock at $13.84, right at this historical support level. However, the shares continued to drop. And I said, okay, now what we're going to do is that we're going to now watch for the next support level to get hit. That next support level was at $12.26. Right below there was support at $11.86. So I said, okay, let these shares come to us now. They've broken through key support. So what I want to do is, I don't want to go buying the common stock. What I want to do is, I want to get really aggressive. Back to the daily chart. What we decided to do was to take advantage of what I like to call fat implied volatility, meaning you had traders buying up these put options at very, very inflated values. So I said, okay, what we're going to do is that we are going to sell 50 contracts, that's 5,000 shares, at the $12.50 strike price, bringing in another $1.15. So if those shares were ever put to us, our basis cost is $11.35. That's a great bargain, especially for a stock that was trading at the time with RSI below 10. Right? So it was a no-brainer. So we brought in $1.15, multiply that times 5,000, and you get your number. We brought in that premium, and the support level held. We began to consolidate. We broke out above the upper band of resistance on the 4th of September. And then fast forward to Friday, a news item came out that the company was seeking buyers to buy them out because they have a lot of debt. and the shares just took off. Now, you might be saying, why didn't you wait for the buyout? They're hoping that somebody's going to want to buy them, right? They have a lot of debt, Carbonite. So I decided first out, best out, and we began to unwind the position. So we closed out the September 15 put. We bought to close that position. Remember, we sold to open at $1.15. We bought it back at 80 cents per contract, bringing us in 35 cents per contract, or a 30% profit. We booked a $1.74 per share profit on the common stock. That was a 12.6% profit. And on the put options, the 1250 put options that we sold to open, expiring in October. And if I said September on those 1250s, I made a mistake before. It's an October strike. We brought in $1.15. We're going to let those expire worthless. Now, if we begin to see the shares roll over here, I may just close out the position. But at current, we look to stand to make about 100% on that trade. That, of course, will change if we need to buy to close out that position. Either way, we're going to stand to make a handsome profit on that trade. So 3 separate trades here. 2 using the sale of put options to bring in premium, to bring in income. The other was the use of common stock. And the thing to remember here, folks, is that weak stocks tend to get weaker. And the only reason why the shares rallied as they did this past Friday was because you had a news event and you had a lot of shorts looking to get squeezed out of their positions. Remember, they were asleep at the switch. We took advantage of them not paying attention. Now, we do have another trade open right now, and that's Angie's List. Now, Angie's List is very similar in terms of Carbonite, in that it was at extreme oversold levels. We are profitable on this trade now. We were in a very tight consolidation. We broke out here on the 5th after we flashed a doji star formation on the 4th, and we had a continuation move higher this past Friday. Now, the markets are beginning to firm up a little bit here. All right, so we may even get a breakout fairly soon on the small caps. What will that do for Angie's List? In all probability, they will proceed higher. Now, what's the catalyst here? An extreme oversold condition, yes, but the catalyst to send the shares higher are, again, this one has a lot of shorts, a big short interest, and they are asleep at the switch. They're not paying attention. They're not covering. They're not watching the charts. So we're going to take advantage of them being asleep at the switch. And if the opportunity presents itself, we're going to add more to the position. So I hope you got some value out of this commentary. If you have any questions, leave a comment below. Hit that like button. Share this video with a friend. And everybody have a great remainder of your weekend and have a profitable trading week. Be well.